Hey everyone, it's Logan here, and just when you thought things couldn't get any wilder, hold on tight. Soon, the mortgage giant Fannie Mae will eliminate its minimum credit score requirements for home purchases, coinciding with the Trump administration's proposal of portable mortgages. This means that if you secured a loan at 3% previously, you could theoretically bring that loan with you to your next home, potentially opening up hundreds of thousands of homes that might not have been available on the market otherwise. That's why we need to discuss what's unfolding, the consequences it could have on the entire housing market, and the reality of whether we might actually see portable mortgages. If we do, it could lead to significant winners and even bigger losers. Before diving in, if you appreciate videos like this where we simply present the unbiased facts, I'd greatly appreciate it if you could hit the like button, or subscribe if you haven't already. It may seem trivial, but it really helps out a lot. As a thank you, I'll do my best to read and respond to as many of your comments as possible. Thanks so much. First, let's discuss the change that will have the most immediate effect on the housing market, which will officially take place on November the 16th, the removal of the minimum credit score requirement. For some context, this all starts with what are known as Fannie Mae and Freddie Mac. Although they sound like rival rap artists, they are actually federally backed mortgage companies that buy and guarantee loans from lenders and banks. When someone wants to purchase a one-bedroom home in San Francisco for $2 million, they go through a bank or lender, allowing the buyer to borrow most of the purchase amount. However, what many people don't realize is that, when you get a mortgage from a bank, it's not the bank that holds on to it and waits patiently for you to repay it over 30 years. Instead, banks typically bundle all their loans together into one large package, which they then sell to investors as mortgage-backed securities, making a small profit in the process. This is why most banks have standard mortgage requirements that you must meet, such as a minimum income, a maximum amount of debt, or a certain credit score above 620, which is going away soon. We'll discuss that point shortly, but because investors aren't always eager to buy these mortgage-backed securities, the government created a safety net in 1938 to guarantee the purchase of mortgages that meet specific criteria. This is how Freddie Mac and Fannie Mae came into existence. Now, here's where things get interesting. Over the past few years, Fannie Mae and Freddie Mac have been increasing the amounts they're willing to finance, raising their loan limits from $500,000 in 2020 to as high as $1.5 million if you want to buy for units. The rationale behind this is that home prices have risen, making it easier to qualify for larger loans, and expanding the pool of buyers eligible for those loans. And now, this is the part that's starting to raise concerns: the elimination of minimum credit scores. As mentioned earlier, starting November the 16th, Fannie Mae will no longer require a minimum credit score of 620. To quote them, "This is designed to expand access to mortgage credit, particularly among borrowers with so-called thin credit files or non-traditional credit histories." Additionally, they will rely on their own comprehensive analysis of risk factors to determine eligibility. Regarding the risk factors they will consider, the homebuilder PY stated that their underwriting standards remain the same and that they can now look at alternatives to your credit file known as a Vantage score. This score examines your payment history outside of your standard credit profile, potentially including your rent, utility, and phone payments, and anything else that might not show up. They believe this will allow many more borrowers to qualify who would otherwise have been excluded. Just picture someone who has been paying their rent, utilities, and bills on time for over a decade, but just got their first credit card, resulting in a credit score of 600 due to its novelty. Prior to this new rule, they would have been excluded despite being a strong borrower. Now, they could qualify for a mortgage as long as they meet all other criteria. Essentially, this doesn't mean that lenders are completely eliminating risk or giving loans to anyone with a pulse. However, larger loans, such as increasing loan limits and allowing prior appraisals to be used in loan approvals. Therefore, it makes sense that they are removing the minimum credit score requirement in favor of being able to utilize alternative data. From my perspective, this doesn't necessarily mean that banks will be lent in. It does indicate they are no longer solely reliant on credit scores if everything else looks favorable. So, what's the risk? In my view, this isn't surprising at all because lenders have been doing everything possible over the past few years to issue more loans. This is a repeat of 2008, where buyers were granted loans they couldn't afford, leading to a market collapse. There's another topic gaining a lot of attention right now: mortgage portability. For those who are unaware, this was recently proposed by the Trump administration as a means to transfer your existing mortgage rate from one home to another. For instance, If you bought a home in 2021 with a locked-in interest rate of 2.875% for 30 years and you don't want to move because that would require giving up that loan and obtaining a new mortgage at 7%, this would resolve that completely. You would simply apply your existing mortgage to your next home, freeing you from being locked into your current house. Now, obviously, this is quite controversial because, on one hand, many sellers are stuck in the market because they can't afford a higher mortgage rate. This would entirely solve that issue and lead to a surge of inventory flooding the market. Yet others argue that this only benefits those who already have a low-interest mortgage, while new buyers would have to secure financing at today's higher interest rates. So, who's correct, and could this actually happen? In theory, here's how it might work. Imagine you have a 3% mortgage on a $500,000 home, and you want to sell it to buy a $700,000 home with a portable mortgage. Instead of applying for a new loan at 7%, you would contact your lender, requalify, appraise the property, and if everything checks out, your existing mortgage would just transfer to the new home. Simple. Of course, if the new home is more expensive, the buyer would likely need secondary financing at a higher interest rate. If it's less expensive, they would just pay the difference. In terms of who benefits the most from this, the honest answer is existing homeowners because they can retain their current mortgage rate and simply transfer it to a new house. However, the expectation is that this would unlock a lot of lower-priced inventory that wouldn't have otherwise reached the market, allowing more first-time buyers to qualify. So, what are the chances of this actually occurring? To discuss that, we need to look at lenders. This is where things get tricky. Typically, in a market like this, when you sell a home, your loan is paid off. Having 2% mortgages on a bank's or investors' books usually results in a significant loss for that entity. This is one of the reasons Silicon Valley Bank went under. It's also why banks are facing some of their largest unrealized losses in history. When they tie up capital for decades at rates that are significantly lower than today's rates, those loans become, for lack of a better term, completely worthless. That's why lenders and investors generally presume that, when they extend a loan, it will be repaid, on average, every 12.8 years when that borrower moves on to something else. However, if mortgages become portable, those loans will have to remain on the books for decades. As a result, lenders and investors will likely need to raise interest rates for everyone else to offset that risk. If they don't, the entire banking system could end up becoming the safety net for low-yielding residential mortgages for decades. We all know what happened the last time the banking industry became overly reliant on residential real estate. If mortgage portability becomes a reality, we must ask ourselves, will this unlock more inventory in a way that allows more individuals to enter the market and improve mobility? Or will it push prices up even further due to increased demand from homeowners looking to buy something else with their record low interest rates? Fortunately, we don't have to speculate too much about this because a similar system is already in place in Canada. In Canada, they allow you to transfer your mortgage from one property to another if you qualify. However, there's one significant difference. Canada does not have a fixed 30-year term. Instead, most of their loans are fixed for 1 to 5 years and then reset once that term ends. This makes mortgage portability much simpler because banks don't have to worry about holding onto that loan until maturity. Even if they do keep it, it's only for a few years until it eventually goes away. So, is there any chance this could happen in the United States? The reality is that implementing this would be very challenging because you can't retroactively change mortgage laws across tens of millions of loans. It would be akin to investing in a company expecting to get your money back in 5 years, only for the government to come in and say, actually, you're going to be repaid in 30 years. Disagree? Too bad. Bye. In the US we have what's called a due on sale clause that mandates the loan stays with the property and is paid off in full when the title of that property transfers. Making mortgages portable would require completely overhauling laws and processes for banks and lenders. It would necessitate rewriting how mortgages are structured and establishing new pricing models for lenders and banks that have to hold on to these long-term, low-interest rate mortgages. That's why, as much as I wish this were the case, because I believe the net benefit of portable mortgages would outweigh the slight increase in demand, resulting in more property tax revenue, unlocking inventory, and allowing new buyers to take their place, I realistically can't see this happening unless the government backs these loans with taxpayer funds, at which point, sure, anything is possible with enough money. Ultimately, I do not believe this will come to fruition. As much as I support it, logistically, it cannot happen without someone getting severely affected. So, will all of these housing market policies simply lead to a repeat of 2008? On a fundamental level, the answer is probably not. Throughout the 2000s, Home prices were driven by rampant speculation, easy access to funds, and short-term adjustable-rate mortgages that enabled anyone to obtain a loan, even without a down payment. These were often referred to as ninja loans, which stood for no job, no income, no assets. Additionally, many of those mortgages included what's known as a balloon payment, meaning that once the introductory rate payments ended, homeowners would face significantly larger payments, and many thought, "That's fine, I'll sell the home for a higher price before those payments come due." This turned out to be a complete disaster. Once owners couldn't afford the higher payments, they all began to sell simultaneously, flooding the market with inventory. Prices collapsed, which fell back on the banks, leading to widespread chaos. Even though we have seen similar price increases in the last 5 years, this surge was instead driven by record-low mortgage rates that encouraged people to take on significant debt because financing was cheap. And that debt is not going away anytime soon since it's fixed until the property is fully paid off. Additionally, nowadays, buyers must still have a certain down payment. They still need to meet certain income criteria. They still have to verify their employment. In simpler terms, we're not seeing individuals with no money down buying properties they shouldn't qualify for in the first place. This is why the chance of a 2008-style crash occurring due to these conditions is relatively unlikely in the foreseeable future. It's clear that the current administration wants to do something to address the affordability crisis. And while I support the idea of being able to transfer your mortgage from one house to another, at the end of the day, the most significant change will come from building more homes. The housing market fundamentally comes down to supply and demand. When supply is constrained due to zoning regulations and high construction costs, housing prices will inevitably rise. Perhaps I will eventually be able to create the perfect 3D house, and in 30 years, you could push a few buttons and have the blueprints automatically approved through a program like Chocolate. But for now, increasing housing supply must be the top priority. Otherwise, I hope you enjoy living with roommates.